Let's establish the facts right here, right now. Welcome to this explainer, where we're going to lay out the cold, hard financial reality of the global AI infrastructure explosion. Listen, we aren't here to look at hype today, and we certainly aren't here to guess about the future of consumer gadgets. Instead, we are putting a $10 billion institutional investment research report from June 2026 on trial. We're going to act like prosecutors here, looking strictly at the data, the balance sheets, and the structural monopolies that define today's artificial intelligence landscape. Okay, let's tackle the massive elephant in the room right away. It's the hook that absolutely dominates financial headlines everywhere you look. Everyone says NVIDIA is too expensive. And retail investors, they look at a $5.1 trillion market cap, they look at a stock price that has surged exponentially, and they just get sticker shock. But here is the core conflict that is going to define our entire analysis today. While retail investors are agonizing over the share price feeling quote-unquote too high, institutional researchers managing billions of dollars, they're asking a completely different question. There is a stark divide in how these two groups look at the exact same company. The retail focus is entirely fixated on the current stock price and traditional trailing metrics. Meanwhile, the institutional focus is zeroed in on infrastructure monopolies and forward-looking growth formulas, like PEG ratios. The absolute core narrative that we need to internalize right now is this: NVIDIA does not just sell GPUs. Seriously, that is a totally outdated way of looking at this business. NVIDIA owns the infrastructure layer of artificial intelligence. They deserve to be evaluated as a massive platform, not a traditional semiconductor company. Part 1, Exhibit A, the AI infrastructure engine. Let's look at the numbers. To truly grasp the financial explosion driving this company, we have to look back in time to the 1849 California gold rush. Think about it. Most prospectors who went looking for gold went absolutely broke. But the people who sold the picks, the shovels, and the jeans, people like Levi Strauss, they built absolute empires. Well, NVIDIA is the ultimate pick and shovel play of the modern AI gold rush. Whether OpenAI, Google, Meta, or some brand new startup wins the AI software race, it literally doesn't matter to NVIDIA. They all must buy NVIDIA's infrastructure to train and run their models. And here's the undeniable proof of that transformation: $193.7 billion. That is NVIDIA's data center revenue for fiscal year 2026. Data centers now make up a staggering 90% of NVIDIA's total revenue. So the days of thinking of them as a gaming graphics card company, those are entirely over. This number proves their complete, definitive metamorphosis into an undisputed AI infrastructure giant. Actually, let's pause and really let the weight of this next metric land. 85.2% year-over-year revenue growth. The company's total trailing 12-month revenue sits at $253.5 billion. Think about that for a second. Growing your top-line sales by 85%, when you are already operating at a $250 billion scale, that is practically unprecedented in corporate history. But it gets better, because it's not just the sales that are growing. Earnings per share, the actual tangible profit attributed to each share of stock, is exploding at an astonishing 215%. This means that NVIDIA's profitability is massively outpacing its top-line sales. As they sell more, they are becoming exponentially more efficient at turning every one of those sales into pure earnings. So how exactly are they achieving that EPS growth? Take a look at these margins. A gross margin of 74.1%, an operating margin of 65.6%, and a net margin of 63.0%. To put that into perspective, Apple, which is widely considered one of the most profitable companies ever, sits around a 25% profit margin. NVIDIA keeps 63 cents in pure profit for every single dollar of sales. These are luxury goods level margins. We're talking Hermes or Ferrari margins, somehow operating inside a technology hardware business. Honestly, with margins like that, you'd think they were hand-stitching these GPUs in Milan. Which brings us right to return on invested capital, or ROIC. Basically, how well does management turn cash into more cash? Well, a 114.3% return on equity proves that NVIDIA generates significantly more profit in a single year than the entire book value of its equity. Combine that with an equally impressive 52.7% return on assets, and the efficiency is just extraordinary. Keep in mind, a standard good company might see an ROE of maybe 15 to 20%. The result of all this is what we call a financial fortress. Operating cash flow sits at a massive $125.6 billion. Free cash flow is $46.3 billion. They have $53.2 billion in cash on hand against a total debt of just $12.8 billion. So the absolute crucial point here is that NVIDIA could pay off its entire minimal debt load 4 times over, right now, today, just using the cash sitting in the bank. This is quite literally what a pristine balance sheet looks like.
Part 2. Exhibit B, the CUDA software moat.
Now, skeptics will say hardware is eventually replicable, right? And they'd be right. So we have to shift our argument over to software. Enter CUDA. CUDA is NVIDIA's proprietary software platform that lets developers program GPUs for AI. Think of it as the iOS of AI. Just like apps are built for iPhones, AI models in major frameworks like PyTorch and TensorFlow are optimized for CUDA first. Imagine if every blockbuster video game was made exclusively for the PlayStation. Even if an Xbox was cheaper, you'd still buy the PlayStation just to play the games. Well, CUDA does exactly this for AI developers, creating massive, painful switching costs for anyone trying to leave the NVIDIA ecosystem. And the network effect securing that moat, it is absolutely massive. Over 4 million developers worldwide use CUDA. If an enterprise suddenly wants to switch to a competitor's chip to save some money on hardware up front, they have to completely rewrite their code. That means months of incredibly expensive engineering work, which completely neutralizes any of those upfront hardware savings. Basically, once you're on NVIDIA, you stay on NVIDIA. So, despite all the noise you hear in the financial press about new chips hitting the market, the result of that software moat is absolute, monopolistic dominance. NVIDIA commands roughly an 80% market share in AI accelerators. Custom ASICs hold about 10 to 12%, and AMD is trailing at 6 to 8%.
Part 3. Exhibit C, the competitive landscape.
Let's be completely objective here and look at the rivals trying to chip away at that market share. First, you have AMD, bringing some real price and memory advantages, but they are suffering a massive software gap against CUDA. Then you have Broadcom and custom ASICs, which are application-specific chips optimized for very narrow tasks, but they fail at general-purpose AI training. And finally, you have Google TPU and Amazon Trainium, which are incredible for massive scale, but they are locked entirely within their own internal cloud networks. They aren't even for merchant sale. Plus, you have to remember that NVIDIA releases a new full-stack generation every 12 to 18 months, which vastly outpaces the 3 to 5 year product cycles of its competitors.
Part 4. The closing argument. Valuing institutional growth.
Okay, we've seen the fundamentals, we understand the moat, and we've analyzed the competition. Now it's time to address the actual mathematical valuation of the stock. Is a trailing price-to-earnings multiple of 32 times actually cheap? To a retail investor anchored in the past, paying $32 for every $1 of historic profit seems incredibly expensive. No way around it. But remember, the market doesn't price assets based on what they did yesterday. It prices them based on what they're going to do tomorrow. When we shift our focus to future expected earnings, the valuation paradigm completely flips on its head. The forward PE drops drastically to a highly attractive 16.55 times earnings. Compared to its 5-year historical average of 35 to 40 times forward earnings, NVIDIA is trading at a massive, massive discount relative to its own history. But smart money, they rely on a much more advanced formula, the PEG ratio. This is the price-to-earnings ratio divided by the company's earnings growth rate. It is the ultimate institutional equalizer. The rule of thumb here is super simple. A PEG ratio of exactly 1.0 means a stock is fairly valued. Anything below 1.0 indicates that a stock is deeply undervalued relative to its massive growth rate. You are essentially paying a discount for future expansion. And this, right here, brings us to the ultimate aha moment of our explainer. NVIDIA's PEG ratio sits at 0.65. For a little context, Microsoft is at 2.5. Even historically, NVIDIA has averaged around 1.5. A 0.65 PEG means that despite being larger and more dominant than ever in its entire history, NVIDIA is trading at its cheapest valuation relative to its growth in years. Part 5. The exit strategy, institutional thesis breakers. Listen, institutional investing is never about blind hype. It requires strict, objective parameters that tell you exactly when you are wrong. Here are the specific data-driven triggers that break this investment thesis. If revenue growth drops below 20% for 2 consecutive quarters, well, the hypergrowth phase is stalling. If the PEG ratio climbs above 1.5, the valuation has become stretched. If we see a mass exodus of developers eroding that CUDA ecosystem, if AI infrastructure spending entirely collapses, or if a major unforeseen technology disruption bypasses GPUs entirely, if any of these specific metrics trigger, the fundamental thesis breaks and it is time to execute a disciplined exit. But barring those specific thesis breakers, we're left with a profound institutional reality. The total addressable market for AI infrastructure spending is projected to hit $3 to $4 trillion annually by 2030. Think about the scale of that. When a company holds an 80% monopoly over the essential picks and shovels of a multi-trillion-dollar technological revolution, generating 63% net margins while trading at a 0.65 PEG ratio, well, the ultimate question isn't whether it's too expensive. The real question is this: is the true financial risk owning NVIDIA or not owning it?